Good afternoon. My name is Richard Davies, President and CEO of Candia Financial Credit Union, and I want to thank you all for joining us for our summer speaker series. This is our third of 4 webinars focusing on current financial topics for our members. In our first webinar, we focused on navigating COVID-19 market conditions, covering the impact that the recent volatility has had on the stock markets and the economy. Our second speaker focused on attention on tax and estate planning, moving from estate planning to estate doing. Today we are pleased to have a portfolio manager and lead strategist from Mackenzie Investments, one of Canada's largest investment firms, who will provide his economic update and market outlook and how they will apply these views to their portfolios. Please note that for optimum sound quality, all participants have been placed on mute. If you have any questions, please feel free to submit them through the chat function. We will endeavor to answer as many questions as possible at the conclusion of the presentation. If we don't have the opportunity to answer your question, contact information will be provided at the end of the presentation, and you'll be given the opportunity to submit your questions and comments directly to our team of professionals, and we'd be happy to follow up with you directly. This slide is bull and bear markets from January 1960 to December of 2019. What this chart shows is the bull market runs lasted on average 61 months with over 100% cumulative returns. On the flip side, bear markets lasted on average 17 months with cumulative losses of minus 30%. Over this period, investors who stayed invested had a 10% annualized rate of return over the entire period, including dividends. Investors that sought the advice of experienced financial advisors were far less likely to jump out of the markets at the wrong time and miss significant upside returns. This next slide shows what happened just this year. We had a high in the market on February 20th at a TSX level of just under 18,000. By March 23rd, we had a dramatic drop to a low of 11,300, and today, just over 5 months from the low, we are at just over 16,000. In periods of declining markets, emotions can run high and bad decisions can be made. But it is exactly in times like these that a long-term outlook is vital. Sticking to long-term objectives and being in close contact with your financial advisor is a must. Today we have with us Paul Taylor, who is going to give us Mackenzie's economic update and market outlook going forward and how they will apply this update and outlook to their portfolios for investors for the long term. Prior to joining Mackenzie, Paul worked for 14 years at a major Canadian bank as Chief Investment Officer, where his responsibilities included making tactical assessment allocation decisions across institutional, high net worth, and retail lines of businesses, and leading large teams of investment professionals. Over his career, he has held senior investment roles at other leading Canadian wealth management firms. In addition to his investment management experience, Paul also brings to the team an extensive history of participation in media communications, including appearances in BNN, CNBC, Globe and Mail, Financial Post, and other media outlets. Paul earned his MBA at the Smith School of Business at Queen's University, holds a BA of Economics from the University of Western Ontario, and he is also a CFA charter holder. So now I would just love to turn it over to Paul.
Richard, thank you. I think your slide a couple slides ago is a really useful jumping off point because you indicated the average bull market lasts about 61 months or about 5 years, and the average bear market or the downdraft lasts about 17 months. And then you showed that the sell-off earlier this year lasted not more than about 4 or 5 weeks. So the real question is, are we done? And where do we go from here? So We'll start just an introduction. I think people know who Mackenzie is. I work on the Multi-Asset Strategies team. It's one of 14 different asset management boutiques at Mackenzie. Multi-asset refers to the fact that we're the team at the top of the house that makes the decisions to allocate money across the asset classes, across cash, bonds, equities, of course, within equities, across the various different geographic regions, and while we manage currencies, and we have other tools that we can employ. You've already done a good job of introducing me. I appreciate that. We'll split this into two. I'll spend most of my time on the broad economic backdrop and talk a little bit about markets. At the back end, I'll talk about specifically the portfolios that I focus on, which are called Symmetry for us, so I can sort of bring to life, how Mackenzie is kind of managing through this. So if we advance to the next slide, the question at this juncture is, there's a lot going on, and where will the markets take their direction from? So here you can see a whole bunch of pieces of information that are out there. Obviously, top left, COVID is front and center. I'm going to talk about that in more detail on the next slide. Top right, one of the underappreciated pieces of information is what happened not last week, but the week before in Jackson Hole, where the U.S. Federal Reserve, after review, about every 5 years, they review their broad policy mandate, and they made a change, a fairly fundamental change of direction. So as we are aware, our central bank here in Canada, they target a 2% inflation target. When we're below that, then they try to stimulate the economy to get back up to that 2% target. When we're above that, they try to tighten things down. But the 2% is fairly arbitrary. The big change coming out of Jackson Hole a week and a half ago is that the U.S. Fed has indicated that they're changing direction. And they're no longer targeting 2%, but they're looking at an average inflation target of 2%. That may sound like splitting hairs or semantics, but it is important because what it indicates is that they will allow inflation to run hotter than 2% if inflation has run below 2% for a period of time. So bottom line, we'll talk about this a little later, is it further provides evidence that interest rates will remain low, not just for the next quarter or year, but likely there is the potential that they will stay very low for 3 to 5 years. Anyway, we'll talk more about that. But just below that, equity, certain equity markets at all-time highs. Does that make sense in a world where, we've had the social distance and there's been clearly an economic effect? Again, we'll talk about that. Racial tension, Black Lives Matters clearly has, potential political implications come November 3rd. U.S.-China tension, kind of an ongoing longer-term issue. A lot of focus on Facebook, Apple, Amazon, Netflix, Google or Alphabet, and Microsoft, and how well they're doing in the current environment. The others, obviously, the U.S. presidential election, and will we have 4 more years, of the Donald Trump presidency or not? And then bottom right, back to COVID-19, the real issue, and I'll pull this together by saying this, the real issue is how COVID plays out from a health perspective and from an economic perspective, how we slowly regain our footing. So if we go to the next slide, let's just talk about COVID specifically, because again, it is a health crisis. It is an existential threat. And it is because the only antidote at this point in time to COVID is social distancing. We hope that there will be a vaccine, but as we heard yesterday with AstraZeneca, backing off in some of their phase 3 trial testing, that a vaccine could very well still be, quite a ways away. In terms of therapeutics, we do understand that remdesivir is people are sick, that they can be treated, and it does have some benefit, but at this stage, there's no magic bullet. And the challenge with COVID is that it's the double whammy from a health perspective. One, it's highly contagious. You look at the transmission factor or the R factor, the number of people who, if I'm affected, I will spread the virus to, it's very high versus, for instance, the seasonal flu. So it's highly likely to spread. That's the one issue. But the other part of the double whammy is that there will be people who, if they are afflicted with it, will die. So that is a very lethal combination if you're an epidemiologist. Just the evidence, on the chart here, we have the U.S. on the left, Canada on the right. The line that I want you to focus on, there are three lines there. Just focus on I believe it's dark blue, the dark blue squiggly line, and that shows the number of daily new cases. So in the U.S., we had a peak, thought we were by it in early April, and trended lower. And then, of course, a bunch of states, in particular southern states, opened up, and the number of new cases ran up towards 70,000 a day. Now, since then, we've rolled over, but this is just as we start to go into the cooler weather of the fall and start to get into seasonal flu and the potential for this second wave. A very different experience, if you look at Canada and a lot of other countries, and that is Canada had a big peak back in that ended in kind of May. And the only thing to be a little concerned about is as we've opened up, in July, August, little bit of a slight upward trend. But this is the big issue, and we need to see, whether we get the extent to which we get our arms around, the containing the spread of COVID, and or, the developments of effective vaccines or therapeutic treatments. Until we have that in place, social distancing will still be at least partly in effect. I'd say the one thing that I'll offer up, we can talk about this more in the Q&A session towards the end, is that I think that there is a very limited appetite going forward in most jurisdictions for nationwide lockdowns, as we go forward, which means that COVID will be there, but it's the economy and how we regain our footing in a world where we slowly start to go back to work. So let's take a look at that. Let's look at the economic impact. Let's go to slide 9. So the question is, what kind of economic recovery are we likely to see? Well, this is what you see here on slide 9 is consensus economic growth forecasts for 2020 and 2021. So for 2020, overall, yes, we had a huge negative in Q2, but for all of 2020, if you take let's take Canada as an example. For the full year, we're likely to be down in 2020 somewhere in the neighborhood of about 5-6%. Then, as we go back into 2021, we're probably looking at better than the trend coming out of 2019. So we're probably going to have 3 or 4% growth. But most importantly, we're not going to get back to the level of economic activity in dollar and cent terms until probably 2022. So you have a big drawdown, then you'll have a bit of certainly a fairly strong bump in 2021. But even though the percentage, in percentage terms, we have a sharp snapback in 2021, the global pie of the broad economic activity in dollar terms or earnings for corporate Canada and corporate U.S. will not regain their the same level as they were in 2019 until 2022. So the question is, are equity markets right to be setting, all-time highs? Well, let's go to page 10. Let's talk, and I'm only going to focus on the broad economic backdrop with just a couple of slides. On page 10, we're going to look at the manufacturing sector. On page 11, we're going to talk a little bit about the consumer. But let's stick with page 10 here. Page 10 shows on the left-hand side industrial production. Well, this is output from factories, around America and around the world. And we can see how big the drawdown was from an index of about 100 coming into COVID. You can see that we fell by kind of 20 percentage points off that high point. Now, since then, if you take the U.S., we've come back pretty sharply, and that can be seen if we look at the right-hand chart. The right-hand chart shows one example of a PMI, a Purchasing Manager Index. So once a month, we go out and we survey purchasing managers all the way, all across America and around the world, and we ask them about how conditions are. Where's their order book? Are new orders rising or falling? Are they hiring? Are inventories speeding up or slowing down? Such things as that. And then we create a composite. Anything above 50 is generally associated with an economy on the mend. Anything below 50 shows that we're losing momentum. So, for instance, in the Great Financial Crisis, the U.S. Purchasing Manager Index fell from mid-50s to the low 40s. Well, by comparison, you can see in 2020 that the world composite PMI went from about 53 to below 30. But since then has bounced back above 50. So what that indicates is that as people have gone back working, we've got, production, industrial production is certainly back. The order book is certainly starting to rise. Inventories were drawn down, and we're getting going in the production of goods. That's one side of the economy. The challenge is, of course, COVID dramatically affects the service side of the economy. I don't have a slide that talks to this, but I think we all just intuitively know that the service sector is going to be very slow to get back up and running. I live in Toronto. I actually went to my first movie on Friday night just to sort of check out how things were. In the theater I was in, I think there was about 20% attendance in the theater, and that'll take 6 months for us to go to get to much more meaningful attendance. So the corporate sector, the manufacturing sector, recovering, but still a ways to go. If we now look on page 11 at the consumer side, this is where we really need to see that we're bouncing back. And of course, this has been affected because, in the U.S., for instance, there were north of 25 million people laid off as a result of COVID. Now, half those jobs have come back, and we can see this in some of the data. We can see retail sales on the left-hand side. They've actually bounced back sharply, and they've bounced back to where they were prior to COVID and social distancing. Not surprising, that's retail sales. I can still sit at home and I can go on and I can order golf balls, from Amazon, or I can order, books or whatever. So that works, but again, it's the service side that is not reflected in this data. On the right-hand side, consumer confidence. It's interesting to see that while retail sales have repaired, consumer confidence is still lagging. It has bounced back somewhat, but that really, I think, reflects consumer, sort of only a slight bounce back in consumer confidence. Is that there's still limited visibility out there in the marketplace. So, the consumer is still in repair mode, and it will take some time for us to, with confidence, say, absolutely, we're going to get back to that V-shaped recovery. So let's go and let's look just briefly. Let's round out this discussion of the economic backdrop. Just to reiterate, where we are from a rate perspective. I'm going to focus on the right-hand side of the chart here. Again, I point out there's a different regime or a different philosophy in place in the U.S. in terms of the U.S. Federal Reserve, the U.S. Central Bank, and interest rates. But what we show here is we show the FFR is the U.S. Fed funds rate. It's the equivalent of the Bank of Canada rate here in Canada. It shows, how it has played out over the last while. And if we look in the market and what the market implied future Fed funds rate is going forward in 2021, 2022, and 2023, interest rates will be where they are. And that's simply because the central bank is going to want to be as helpful in getting the economy back up and running, just as Congress in the U.S. Is going to be as accommodative as they can in getting the economy up and running. If we create inflation down the road, then we'll deal with it down the road. So the other issue, if we go to page 13, we can talk a little bit more about this, but the other thing that certainly markets are very much focused on is November 3rd. We have, I think, what we would all agree is probably one of the most important elections of our lifetime. And that is, do we continue with the status quo with a Republican president, a House of Representatives that's controlled by the Democrats, and a Senate that is controlled by the Republicans? Or do we get, a different version where we have Joe Biden as our president? If we get a Joe Biden presidency, there are two flavors. It could be a Democratic presidency with a split Congress, which is what you see in the right-hand column. Or we could get a Democratic sweep or a Democratic wave, which is where the presidency and both houses of Congress are controlled by the Democrats. I'm not going to go through the details here. If you want, we can talk, further about this, about what the implications of one versus the other are. There's something we haven't talked about, on this chart that I think is most likely to have a negative effect from a market perspective. And that is if the outcome of the election is not clear. And that is if we have a hung vote, if we're waiting for lots of mail-in votes, if Donald Trump claims victory that is questionable, that certainly would be very negative for markets. But, that's other than that, I'll lay it out there. I would say this: Joe Biden is a moderate within the Democratic Party. And the markets would have reacted, I would argue, somewhat negatively if a more progressive candidate were put forth as the Democratic nominee. But in fact, I think markets will be fine. So before we go on, let me just, again, hopefully we're by the worst of COVID. Hopefully we don't see more national social distancing. Hopefully we slowly, from an economic perspective, get back to work. If we do, it's going to take us 12 to 24 months to get back to prior levels of economic growth. The equity markets are anticipating that. There are a bunch of things that could go wrong to derail that. So that's kind of where we are. Let's go on. Let me just transition here. I'm not going to spend a lot of time, but just let me talk a little bit about the program I'm responsible for, and I can tell you how we positioned Symmetry in this environment. So let's talk about our team on the next page. These are 5 of us, the senior folks that work on Symmetry. We're supported by about 7 other people. So 12 dedicated people. All we do all day is look at the global macro environment, focus on earnings, the economy, politics, geopolitical tensions, and things like that. And the next page will show you what Symmetry looks like, a suite of 7 effectively balanced portfolios. You have everything from on the left-hand side, 100% fixed income portfolio, 100% bond portfolio, to on the far right, the equity portfolio is 100% equities. One in the middle is 50-50 bonds, equities, called the balanced portfolio. And so, for investors, you just got to decide, for you with your advisor, what for me? What fits my personal needs and expectations. And then, the team that I work on, we take things from there. And by that, I mean, if we go to the next slide, there's a lot of things that you as individuals, might scratch your head on. One is on the left-hand side, a challenging future return environment. Well, we're bond yields right now, so the yield on the 10-year U.S. Treasury bond is about 70 basis points, or 0.7%. That's nothing to write home about. And other bonds, have pretty meager yields. On the flip side, equities have come a long way. Well, it might be a more challenging return environment going forward. Well, what is one to do? Second bullet there, markets can be unpredictable. Who would have thought that in the midst of the greatest health crisis of our lifetimes, that we would in fact be sitting 5 months later with an equity market that in fact is in some cases, as it relates to, say, the NASDAQ and the S&P 500, trading at all-time highs. So that's, to me, that's the essence of unpredictability. Asset complexity. Look, I work in the industry, been working here for 25, 30 years. I can tell you it has become a lot more complex. And then, there's a lot of emerging technology to help one, manage portfolios and manage one's portfolio. So going on from there to the next slide, what we do is with our programs, we leverage our internal capabilities at Mackenzie. As I indicated, we have 18 different boutiques within the firm, very good quality capabilities, Canadian equity growth, value, international passive investing, bonds, you name it, we pretty much got it. We also use some third-party capabilities. We use passive instruments. So by that, we mean ETFs to, in some cases, or futures, so derivative instruments to get us exposure in markets where we want to go in very quickly and be able to exit fairly quickly as well. And then finally, we use some non-traditional asset classes in a lower return world where there's a lot more volatility, where we can access some asset classes that have predictable returns with lower volatility. That can work really well in our portfolios. And in fact, it worked very well for us. We had very good returns through the drawdown related to COVID because we had some of our portfolios not in equities, not in bonds, but in non-traditional asset classes. Let's go on from there. Three things we do. We try to make sure client portfolios are set right for the long term through a long-term strategic asset allocation blend between cash and bonds and equities. We then go in and overlay on a shorter term basis a tactical view, and then we make sure that we're managing the currency exposure because currencies do shift, fairly significantly. Let's go forward from there. Just to, sort of pull it together in terms of our views, we were kind of underweight equities. You can see the top row there. We were underweight equities in the midst of the COVID drawdown, which helped our performance. Since then, we've become a little bit more constructive, where we have more of a neutral allocation to equities. Frankly, we don't have a strong view in terms of relative country bets at this particular point in time. If anything, we're probably looking for opportunities to allocate to some emerging equity markets. Just to round it out, because I know we're running up against time, next slide will show performance. I'm not going to go into, if we go to page 21, just to explain this, these are the rankings of the various different Symmetry portfolios. We focus on the 1 year. Let me just take a number. Balanced, the 77 means that if you look at 77 similar balanced funds in Canada, if you look at 100 similar balanced funds in Canada, we did better than 77 of those 100 funds. So green is good. There's a lot of green on the screen. We've done particularly well. If you go to page 22, this will give you a more detailed look at our balanced portfolio and what's actually in it. So look, let me stop there. Let me just pull it back and summarize. Economically, lots of stuff going on. We got to get by COVID. We're well down that road. The economy's bouncing back. A couple things we need to get by, but we think we will get by that. Symmetry is a program that's designed where we're focused, 7/24 on behalf of clients in getting, portfolios positioned in the right direction. And generally, the performance track record would suggest we've added value in doing so. Let me stop there to see if there are any questions, anything I can go into more detail on.
Paul, we have one question is, what about the shrinking carbon economy and climate change, and the impact it would have?
Well, that has huge implications for us here in Canada, obviously, and that is an issue. So, this is for the U.S. election. This is an area. Energy is a sector that can be dramatically affected, by the outcome of the election, because there's no doubt that Joe Biden, is being pulled a little bit by progressive elements of the Democratic Party and the Green New Deal. So there will be a very different, if and odds do point, to the Dems winning the presidency, and it's about a 50-50 as to whether the Democrats will control both houses of Congress. From everything I've seen, I think there's a good chance that they will. But if that's the case, then energy, there will be more stringent energy regulation to slowly wean us off carbon fuel as our primary source. And, but that'll be a slow transition, but it has much greater implications for us here in Canada. But, is this something that will affect the market, very short term? I mean, it will if the Democrats do sweep, because we'll have, regulatory reform. But still, this is an issue that will play out over the next 5 to 10 years. I mean, I can go into more detail there, but, I would say those are my broad, that's my broad perspective on it. Certainly a very different outcome than a Donald Trump presidency going forward for the next 4 years.
I guess, we are running 1 minute overboard here, but I think one other question brings it a little bit closer to home, Paul. The question was, what about, given the fact that the Conservative Party in Canada now has a new leader, what are your thoughts on a possible early election and that impact in Canada?
Well, the polls, show at this stage that the Liberals, are riding, as typically happens, through crisis, a bit of a wave. And if an election were held now, even, in spite of the fact we just elected a new Conservative leader, and typically there's a bounce there, that the Liberals, might have the opportunity to add to their minority government position or even go beyond there. So I don't think, there's the appetite, certainly not on the part of the NDP. And I would think that the Conservatives at this particular juncture are not keen to trigger an election. Now, if we were to get an election, and let's just say, the Conservatives, did hold the day. I mean, obviously we have, some very different views, where Justin Trudeau has signaled he is going with the throne speech we'll see on September 23rd is a very aggressive policy around climate change and stimulating the economy using generationally low interest rates as the backdrop to borrow money to invest in growth, whereas the platform already announced by the Conservative Party is to say, no, we need to start in here somewhere, start having a discussion about how we start moving back into what they would refer to as a more fiscally prudent direction. So, I don't think we get to the election in the short term, but, intermediate term, we probably will. And already I think the policy platforms are lining up, along the line of, of fiscal prudence and what, would be prudent, given the prevailing circumstances.
Well, thanks, Paul. I hope everyone out there, we hope you've enjoyed today's presentation. We apologize we ran a little bit over, but certainly, hopefully, you found today's presentation interesting, and take comfort in knowing that Tandia's wealth team is just a click away. At Tandia, we want your finances to thrive, and with our partnership with Aviso Wealth, we can help your finances do just that. We invite you to visit our website, tandia.com, for more information on how to get in touch with one of our financial advisors. And our wealth team is ready and willing to provide a no-cost or no-obligation second opinion, or simply the further reassurance you may need in this challenging time. So, Paul, we all really appreciate your time and insight on the economy and the markets, and how you are applying these views to the way you're actually managing the portfolios for investors. One key point that Paul highlighted was that interest rates are going to continue to be low for quite some time, and now more than ever is the time to seek out professional financial advice and look for well-managed portfolios to help you meet your long-term goals. Everyone's situation is unique, and a one-size-fits-all approach simply won't work. So please contact one of our wealth advisors to discuss your own personal goals and objectives. If you have any questions that were not answered today and we didn't have time to get to, please email us at workshops@tandia.com, so workshop with an S at tandia.com, or contact our Member Solutions Center to book an appointment with an advisor. So thank you, everyone, for joining us over your lunch hour. We hope you found this presentation informative and helpful, and very big thanks to Paul for his presentation. So everyone, have a fantastic day, and please stay safe.
Thank you. Bye-bye.